Welcome back to Higher Exchanges. I'm your host, Jesse Redmond, Head of Investor Relations and Business Development at LEEF Brands. I'm joined this week and every week by Morgan Paxia. He's the co-founder of Poseidon. Morgan, what's happening, man?
Oh, just living the dream in the cannabis world. I last week when you asked how I was doing, I completely forgot to mention still basking in the Berkshire Hathaway
Yes.
time we had there, and so maybe I'm still trying to capture some of that.
So tell me quick what goes on there. I see pictures from you and other friends, but tell me the allure of traveling to beautiful Omaha, Nebraska to go to the annual meeting.
It's truly a pilgrimage. Getting to Omaha is no easy endeavor. Usually a connecting flight, but we got there, and it's a whole thing now. On Fridays now they have a whole day of panel discussions with all these different value guys talking about, all different things, whether it's Berkshire related or not. Just, it's like a value minded cohort of people that attend. And then, Saturday, everyone has to get up super early. I think we were in line by 5:15 a.m.
Oh, wow.
Before the show, and you got to do that if you want a shot at getting a seat. And so then you sit down, and it's 4.5 hours of with one slight little break of the goat himself and others, Greg and Ajit this year, talking about all things Berkshire. It's amazing. They do a really good job at this point of everybody clips every sound bite, which is, there's tons of sound bites out there, and you can watch the whole things. But it was really great to be there in person, and especially for such a historic time. I mean, after 60 years, it's not going away, but just reached its time to say I'm no longer be CEO. So, but it was amazing.
Any big any takeaway from the event, or any lesson that was reinforced, or something new you learned?
Well, one of the things I thought was really interesting was, obviously there's tons of like life lessons and things that are talked about, but Warren Buffett mentioned how he looks at companies. What is the first thing he looks at is the balance sheet. He's like, I look at, what is it, 6 to 8 years of balance sheets. Look at that first before even bothering with anything else. And Emily was there, Colin was there, one of my good buddies from back home was there. But with Colin and Emily, I mean, for us, it's like, that hits home for cannabis, no doubt, is, such a great place to start. Forget about, because there's so much noise, and, we've been talking offline a lot about adjusted EBITDA and how much it drives me crazy. Just given all the games and noise in that. But the idea of just starting at the balance sheet is just such felt very relative to what we do.
Yeah.
So.
Yeah, I don't think he would get very far in the cannabis industry these days.
No, I think it's pretty easy to pass over for 90-something% of the businesses. Just, moat, management quality, and balance sheets. It's just, there's just not much that kind of meet all that criteria to be investable. I mean, obviously too, that's this, you could buy the whole damn industry with like few months of T-bill payments. So
yeah. Well, it's cool. I'm glad you got that experience. Maybe I'll get out there one day as well. One other kind of housekeeping item or announcement, Morgan. Did you know that last week, with the popular episode with Zach George from SNDL, we eclipsed 100,000 lifetime listens for Higher Exchanges?
Woo! That's
Woo-hoo.
Amazing.
Yeah.
We need an applause.
Yeah, we need one of those things where the celebration things come up on the screen. There's probably a way to do that I don't understand. But yeah, I was kind of surprised. I keep a spreadsheet. It's kind of hard to track listens. This probably isn't very interesting for you guys, but it's kind of hard to track listens because we do it live on 3 different platforms. Then the recording goes to YouTube. Then the recording goes to podcast platform. So I have a whole spreadsheet with graphs I share with Morgan every week that tracks the listenership. So yeah, was excited about that. It's been a fun project that continues to evolve. We started with 3 of us, and we were on Spaces. Then there went to 2 of us. We stayed on Spaces, and now recently we've moved over to doing it on video, streaming live on LinkedIn, X, and YouTube. And I think that's been a big upgrade. And while a lot of podcasts in cannabis, I think listenership is going down, we've actually seen a pretty strong resurgence from doing the video and being live on the different platforms. So appreciate the support. 100,000 listens. Just wanted to share that good news with everyone and make sure Morgan knew as well. Yeah.
Yeah. We'll have to have a higher exchanges party when we hit the 1 million mark.
Yeah. Well, hopefully we get some catalysts that help the stocks and help the listener base as well. Well, we are not alone today, Morgan. We are pleased to be joined by Seth Yakatan. Seth is a partner at Caton Associates and also a strategic advisor to Glasshouse Brands, among other things. Seth, what's happening, my friend? How are you today?
How you guys doing? I'm so excited to be here. Thank you very much for having me on in the roster spot. It's greatly appreciated.
Yeah, we are excited to talk with you today. And Seth, I think you and I first met. I was trying to think, it was even before I started at Water Tower Research. So that must have been about 2.5, 3, maybe even 4 years ago. I think one of us recognized we were both people in California doing cannabis stuff, and we had an introductory call and just got to know each other a little bit and kind of kept casually in touch. But I had the opportunity to get to know Seth a lot better, over the last really couple of months working on this Glasshouse deal. Seth was running point for Glasshouse to get this deal done with us, and I was doing the same for LEEF. And so Seth and I were pretty much in touch on a daily basis, sometimes 20 or 30 times a day over the last couple of months. And Seth, if I may do a bit of glazing on your behalf, not every professional, responsive, and knowledgeable, and most sincerely, you fit all those categories. Seth is the type of guy that responds to emails promptly, responds to text promptly, finds solutions. And it was great to get to know you better, Seth, over the last couple of months and get this thing done.
Wow. Right back at you, Jesse. I think, by the way, thank you. There were times where I thought Jesse was going to hang up on me or not return my phone call. So you have a few of those. No, look, I think getting a transaction done in any industry is challenging. I like to say that, the Fred Astaire school of dance where you had that, dance card and the steps, there's steps, and you got to know how to do it, and you got to know how to give a little and how to stand a little, and appreciate your professionalism as well. But thank you very much for that. Just like you were saying, Morgan, Warren Buffett's probably looked at 8,000 balance sheets. You get into 200 or 300 transactions in your lifetime, and you can kind of prognosticate what the outcome is going to be and who you're up against and how to work it. And for me, it's just you're only as good as your last transaction. And it's just about getting it done and finding the through line. I've been very fortunate that I have a PhD in cat herding, and it's just how you do it. So,
for those people that don't know you as well as I got to know you, Seth, can you give us a little bit of background on yourself and what exactly it is that you do on a day-to-day basis?
Wow, boy, I don't think we have that long. I like to just kind of say I'm a dumb corporate finance guy. I was on buy side institutionally for 11 years, 4 in venture and 7 in a private equity sponsor calling fund. So I think I really learned fundamentally how to invest in companies early and either monetize them or kill them, and then take things that were large platforms and roll them up and understand the waterfall. So, with that basically like plumbing or electrical engineering background, it gives you a pretty fundamental understanding of capital markets, and I've just used that to get some transactions done. I started a firm with my dad, who was grew up in an orphanage and became a really successful serial entrepreneur in life sciences. Life sciences is really hard, and I started looking at things like wellness and sports nutro and DTC marketing of products to do things that were generating revenue. It led me to the therapeutic application of cannabis because of GW Pharma. I had a bunch of investors that were filthy, disgusting, reverse merger, toxic convert guys who wanted to do a therapeutic cannabis company. So I said, great, raised that company $43 million, took it public on TSX. Thought I was done. And then somehow in 2019, I kept bumping into the planet of ease. when it was on its, I guess, sixth of ninth lives. And somehow convinced someone in that company to work with me and put myself in a position, because I'm not a registered representative of a broker dealer, to be a consultant there. And while I was there for 2.5 years, I basically was in charge of corporate and business development and capital markets, and helped Roe and Corey to raise about $130 million there and facilitate the Green Dragon deal. And then the rest is kind of history. So, I've created this place in the cannabis space, which is amazing. And have parlayed that into a similar role with Kyle and Graham at Glass House, and couldn't be more grateful for that. So I have a constraint in California, which is large and binding, and the ability to do some things outside of California, which is interesting. And fortunately, I did not invest a lot of money into the industry early, and as a result of that, I think I have a different view, because I haven't incinerated a ton of capital in it. But I'm as bullish as anybody's going to be, both on California and the future state. So
yeah, you don't seem super angry or upset, which tells me you didn't invest too much too early.
no. I will tell you both that I did incinerate about $250,000 of my own capital trying to create a synthetic biology cannabinoid biocatalysis system, which horribly failed. But that was about that. After that, I said, I'm just going to invest in classic old metal, because I know what the value is and I know how much money I'm going to put into it. And I know I'm not going to get any of that back. I'm just going to enjoy it. So, 529s, and I've been long Berkshire Hathaway Morgan since my first bonus check in 1994.
Oh, wow.
Ooh, look at you. That's impressive.
The first thing I ever bought was Berkshire A.
Yeah, I appreciate that honesty, Seth, because I think anyone that's been in the investment business for any serious amount of time has had some failures, and sometimes embarrassing failures. And I know Morgan, in the cannabis industry, there's no shortages of humiliations, waiting for you out there. And so I think it's kind of taking those experiences and trying to learn from them as you move forward. That gets to be really valuable. And that's something we've been talking a bit about on the show is, as bad as cannabis has gotten, I think there's a lot of lessons to be learned here. And we spend some time on the show saying, hey, what did we get wrong? What did we miss? And what can we learn, going forward from here, so that when we look back, hopefully 5 years from now, and we're in a lot better shape, we'll have the battle scars, but also have some takeaways and lessons learned. One thing I think people know you from, Seth, is LinkedIn. And you've built a big presence over there. And I think it's interesting to talk about kind of why you did that. And maybe also you can also share what are some of the upsides and downsides of being what I would call social media famous.
Wow. What's occurred to me on LinkedIn is a completely happy accident, and now has become a full-time non-paying job. So it's wonderful. I'll tell you honestly, while I was at ease, I met a guy named Matt Gray, who is a LinkedIn god.
Yeah.
And he had a company called Herb. And we were spending like $1.5 million a month on billboards at ease. And this guy was like spending nothing on Herb and getting all these customers. So I met this guy and I was like, geez, we should buy his company. Turned out he was a total jerk, right? The meeting was basically like, if you can't get me a meeting with Jim Clark today, you're useless, because I'm making $1 million a month on the internet. And I was like, God, this guy's such an idiot. If 10% of what he's saying is true, I'm the dumbest guy in the world, because I have 17,000 followers on LinkedIn. So I'm like, if this idiot can make money on LinkedIn, I got to figure out how to make money on LinkedIn. So the whole LinkedIn thing for me was like, gosh, I got this thing I got to figure out how to monetize. And I just started like range finding. And my stuff started getting traction. And then I went into a hole for 6 months to become part of this broader creator universe, and started paying people for their time and talking to all the people that are big creators on LinkedIn. And somehow it turned into me then totally focusing pretty much on cannabis, and that created another arc. So it's been a really amazing journey. I don't know where it's going to go. For me, it's become a wonderful creative outlet. I get all these things that come into my head, and now they're a LinkedIn post, and it seems to resonate with a lot of people. So I'm grateful for where it's gone and what it's become. But to be honest, for me, originally it was like, oh gosh, I'm going to figure out a way to make a couple grand a month off of this thing, and that just totally failed, completely. And now it's like I have this pulpit, for lack of a better description, or this channel, and I'm just blasting through the things that I think are true, and that seems to resonate with a lot of people. So I don't know.
And what would you any tips for people that are looking to use LinkedIn more effectively for business, looking to generate a following, looking to get their message out there, Seth?
You guys are professionals. Morgan, you probably get hit up 100 times a week to invest in companies, right? So, what I've found on LinkedIn is that for me, LinkedIn has been the greatest top of funnel lead gen system that I've ever used. So I think if you're looking at it from a sales or a marketing or an aggregation perspective, there's certainly ways to do it. I think separating signal from noise is challenging. There's a lot of noise, and it's work. It's just like anything else. You have to put in the work. I think if you are formulaic about it and you go about the, what I would call the thematic methodologies that have worked, you can grow on the platform. But it's work and it's consistency, and it's like diet and exercise. If you meet someone who's overweight and they tell you they diet and they exercise all the time, well, there's a lie there, right? Because it's just math. Like, you're eating at night or you're not putting in the reps. So if you follow a formula, you're going to get a result there. I just think you be careful. It can overwhelm you. But for me, it's been a great access point. I'm at the point now with that where I will consistently have 3 to 4 top MSO CEOs of companies privately message me and basically say, I'm never going to comment on your post, and I'm never going to say anything about what you're doing, but like, your post is bulletin board fodder for my monthly senior SLT meeting, because you're talking about things that I want my team to be thinking about. And that's kind of the biggest reward. So it's been like a lance for me. It gets me into a lot of places. So it's been fun.
Yeah, we found a bit of the same thing with the podcast, and I've generated a bit of following more on X than LinkedIn, but especially with the podcast, sometimes we'll reach out to see a CEO and we'll be nervous, nervous being exaggeration, but we won't know if they'll know who we are or if they want to come on the show, and they'll say, oh, great, love the show, would be happy to come on. And so for the podcast, it's been great from that perspective, and also great long form conversation where sometimes it's harder to get a meeting with somebody and sit down with them face to face over Zoom for an hour. But you come on the show, like last week with Zach was a great example. I've chatted quickly with Zach over the last few years, but never had a real meaningful conversation. He came on the show last week, talked for almost 90 minutes, traded some emails afterwards, and you just feel like you know each other a lot better. So there are a lot of kind of ancillary benefits to putting yourself out there.
Absolutely.
Do you want to talk a little bit, Seth? We're going to get into some other stuff, guys, don't worry. But I wanted to talk a little bit, Seth, about this news we put out yesterday about the new partnership with GLASF and LEEF. And one thing I sensed right from the beginning was that you guys were excited about this deal, and we were excited about this deal. And as soon as I started working on with you, I thought this makes a lot of sense for both of us, and it gave me a lot of confidence it would get done. Do you want to talk a little bit about what we did, Seth, from the GLASF perspective and why it made sense? Then maybe I can complement that with some LEEF perspective.
Look, we've been out as an organization trying to manage retail stores in California for quite a significant period of time. And when we look at the GLASF playbook at retail, and we announced earnings on Tuesday, our retail revenue year over year is up 18.8%. So that's MSO, put anyone in that box, leading caliber it's California leading caliber. So we have a formula, and the formula is working. It's no, I guess, secret that there's distress at retail. And I think for us, figuring out a way to manage more stores, get our product on shelf, and make people more money, given the current environment, is potentially a better return on capital for us than it is to acquire things. And it puts functioning stores that are doing okay in a position where they're doing good. So we see it as potentially being a win-win in a situation where a lot of people are not buying or want to be cash neutral. I think, for us, it's been a great model. And I think given how effective we are at our retail, it's one that for the right, partner works. And we couldn't be happier with LEEF. To be candid with you, Palm Springs is a market that was not on our radar screen. It's a market, because of the seasonality, we did not believe, or I personally did not believe, there was going to be kind of a viable candidate. And when this came up, we were pleasantly surprised that, we're taking over probably the best store out there. And we're really looking forward to the opportunity to make it better. So.
Yeah, I probably should have given people an overview in case they didn't see the news. But essentially what's going on is that we have a store called the LEEF El Paseo, which is in Palm Desert, California. It's a gorgeous store on El Paseo Boulevard, which is kind of the Rodeo Drive of Palm Springs. And we at one point thought we might go deeper in retail, but we ended up with only the one store, and retail currently isn't just a big focus for us. Obviously, Glass House is great at retail, looking to expand their footprint. So it's an opportunity for Glass House to have what's called the managed services agreement, where they take over the day-to-day operations of the store and we retain ownership. And so that's really at the heart of the agreement. So we're thrilled to have Glass House take over the store, run on a daily day-to-day basis. Seth, you guys have a lot of buying power, you have a lot of expertise, and are confident you can add a lot of value to that store. So we're excited for that. The other piece of the puzzle is that we're an extraction company, and we're always looking for clean material. Glass House is obviously a big producer of flower in California, and we've run some of Glass House's material in the past and had great results for our concentrates. And so part of the agreement is that LEEF is getting a consistent supply of Glass House material on a monthly basis for our extraction business. And so, like I said in my post on X and LinkedIn, it sometimes is cliche to talk about a win-win or synergies, but I think in this case it really is great in that Glass House gets to run the store, have more Glass House products there, collect an MSA fee. We get to focus on what we do best, which is bulk extraction. We have the farm, that we planted this year as well for material for our extraction business. And then this just bolsters our supply chain by giving us consistent material on a monthly basis. Some of you may know this, but procurement, we call it, is a full-time job for an extraction company like ours. We have a department that just focuses on finding material. We work with 200-300 farms across California sourcing material. We consume over 200 acres of material every year. So it's a real serious job for us to be out there finding high quality material. And so with the Glass House agreement, we get the professional management of the store, which is fantastic, allows us to focus, but we also get that consistent high quality material from Glass House, where we're really excited about. So I don't know, Seth, from our perspective, I think we have the framework here for a true win-win, and look forward to getting started and executing.
So do we. And just to go back on something you said, I don't believe that's cliche, right? I mean, between the three of us, the body of work on transaction probably exceeds a couple of hundred, right? And when you have a completely one-sided transaction, in my experience, it either doesn't feel good or it doesn't end well for someone. And in a transaction where both parties give a little bit and kind of meet in the middle, and there's a collective good outcome, I feel like that is, if we're going to do a case study on modeling like 300 deals, you're probably going to have a better outcome than someone comes in and crams down and takes over everything and does a scorched earth policy. Just in terms of long-term value. So yeah, I don't think it's cliche at all. And honestly, Jesse, I think that's why it got done, right? There was mutual benefit on both sides. We had 2 or 3 things that were useful. You had a couple things that we wanted, and it's definitely a win-win. So I'm looking forward to it.
Well, awesome. Well, great to talk about the transaction, learn a little bit more about you, Seth. Morgan, why don't we transition to the broader conversation and get Seth's perspective on what's going on in the industry?
Sure. Just real quick, is that the first MSA in retail that Glass House has done?
It is our first announced MSA, yes.
All right. First announced.
Interesting caveat there, right?
Yes.
First announced.
Yeah.
Yes.
Nice. Well, congrats to you both. It's definitely good to see action happening in California. So that's I look forward to seeing more about that in the queues to come. So
stay tuned. Stay tuned.
that's right. Yeah. So we on the show we go through a lot of times, and we'll get to this in a little bit too. We're just trying to distill like what's really going on in the space. Try to really cover things, lessons learned, what's some of the challenges out there, how are people navigating it. But before we get to that, you were mentioning your funnel, how you're looking at a lot of different companies. What do you see right now is working in cannabis, California, nationwide? We've definitely talked a lot internationally in the last couple of weeks, but we'll just focus on the U.S. for now for this conversation. Where do you see companies managing through this industry? We have competition out there. We have pricing, which just seems heading in one direction. Companies are wiping out. But what's working from your mindset with companies that you're in touch with?
I've talked a lot publicly about kind of two different models that seem to work, and two cohorts of companies that seem to work. And when I say work, generate revenue and cash flow. Asset light or inverse asset light models like you've seen in basically edibles at some level. So the cohort of Wild, Groon, Sunderstorm, I'm probably missing a couple in there, Mr. Moxie's Mints or Botanica levels, like that cohort seems to have a model that generates enough money for them to be okay and to continue to grow. I think the continuing to grow part is where people are having questions. I think the other side of that is when you see, inverse asset or various asset light vape models with Rove and Arrow and Timeless, and what you've seen with Jeter at some level, that cohort of both vape and kind of infused pre-roll, but those as cohorts kind of seem to be working. I think there's a second tier of private MSOs that also do really well, that outside of people like us aren't talked about a lot. Like when you start talking about good Stizzy, obviously, but then when you go a tier below and you talk about Good Day Farms and Standard Wellness and C3 and Nova, and I could keep going in that group. So I think there's, I like to say, I think there's about 75 to 100 traditionally lower middle market privates that seem to be doing okay. I think the challenge that everyone's facing this year is growth. So the combination of the lack of additional catalysts and price compression, and figuring out how to operate in capital constraints. The story on the street last week was that pretty much everyone's top line is down, right? So the story that you've had over the last 3-4 years is, well, we're going to 3 more states. And I think what I'm seeing a lot of people do to make it work is kind of come to the conclusion that not expanding into 1 more state or 2 more states this year is probably okay. Preserving the capital that you have is probably okay. And owning the markets that you're in is probably okay, because one of the things that I believe is that the initial underwriting criteria of the industry was based upon exits, right? Well, guess what? There's no exits coming in the horizon. So, what I've been saying is hold serve, and holding serve is okay. But that's kind of some of the things that I'm seeing.
Yeah. Yeah. And are you seeing how these businesses are built from a capital structure? Is there like a through line with how they're approaching it? Because to your point about, cash flow or operating margins of, only so much, how are they supporting their ability to grow, or even, preserving cash with this pricing cycle? What are they doing differently that's, different from like what these public company balance sheets look like for the most part?
I think most of the public company balance sheets are significantly over levered, with debt that starts at 12.5% and ratchets up. I think what I've seen in the entire cohort of names that I've mentioned is that they've lived off of either no money or reasonable amounts of private credit or reasonable amounts of private equity structured as convertible subordinated debentures. And either they don't have the same refi pressure or the same yield pressure that the MSOs have because they've been more disciplined and deciduous in their execution strategy, which have fundamentally been based upon profit as opposed to expansion. And I think that's the major difference that I've seen in the model cohort that I've talked about. Uh, there's a few companies that I've mentioned in that group that I know have relative to market extremely favorably priced deals, right? Like relative to the cohort. So, if the average cost of capital in a private credit transaction in cannabis is, let's just say, all in 13.5% today, and when we could debate that, if you're plus or minus a few hundred, if you're minus a few hundred basis points or 200 basis points from that number, that's a smoking deal. And if you're, wild and you're generating a ton of revenue and a ton of cash flow, and you've got a deal with Chicago Atlantic that you could live with, that's, I think, what I'm seeing people doing.
Yeah. Yeah. It's interesting on the, with some of these companies, and you mentioned like, some of them have potentially some like private equity, like sponsorship, which they want an exit at some point, right? Private equity doesn't have it's not permanent capital. So, it might be working for now, but what do you think these companies are trying to contemplate longer term with their, investor base?
That's a great question. I don't know that I know the answer to that. I think that some of them could be in a position to pay off. Some could be in a position to amend and extend. Some are going to face the same pressure that the MSOs are going to face, which I think between the three of us is why the Vireo deal happened, right? I mean, call a spade, right? So I think you're going to see that continued compression.
Yeah.
But the conversations, Morgan, that I'm having, honestly, are kind of more focused on what do you think I should do for the balance of 2025 and into 2026, and not contemplating that I'm going to get an exit. There is a broad vertical that we have not talked about in beverage where we can take all of the last 10 minutes and throw it out because that's like the hottest, coolest thing that ever showed up, and there's more money flowing in there than I've ever seen, and we're all going to get exits. So it kind of that there's a lot of hype in that space, but I think for most people it's just batten down the hatches and operate. And what I'm telling that group of 15 or 20 companies is just survive. I think survival in 25 and into 26 is going to be the win, honestly.
Do you?
So, sorry, Morgan.
With some of these private companies, because they have a different capital structure and arguably puts them in a more nimble position, do you see them trying to get into hemp more? Are they more aggressive on that side, or what's kind of been any through line there? I know like Wild already does, but yeah.
Company specific.
Yeah.
Two that I talk to regularly and I'll talk about are Wild and Pure Beauty, that have made a pivot pretty hard into that space. I know Cookies and Packwoods have as well, but that's also kind of a bit of a different business model. I think I either talk to operators in cannabis who see that as a necessary move or as a dilution of their core brand and customer. So I think the people who have made the move are convinced that this is either a hedge or something that we need to do because there's no regulatory certainty. And the people who haven't, believe that they are a cannabis brand, and that anything that they're going to do is potentially going to dilute that user base. So I think it's very company specific. In the case of Wild, and let's just talk about that. Aaron Morris could quietly be one of the best CEOs in the industry, to be candid. The decisions that he's made to operate that business in retrospect seem to be pretty consistently correct. One of the things that people don't discuss a lot about Wild is they're very competent in distribution everywhere they are. And I think that the move to hemp for them is an extremely logical line extension, because if you own trucks in 26 states, you probably want to figure out how to put more things on those trucks. And given the level of brand awareness and affinity and love that there is there, the pivot into a differentiated product, and specifically in beverage, I think makes a ton of sense for him. It might not make as much sense for someone who's, an inverse asset light model, that's just in the vape category. So I think that decision seems to me to be very company specific, and it's almost like I don't know what your collective religious belief is, but I'm not going to try and change it. And that's kind of how I feel about hemp.
And Seth, how do you think about most of the public operators getting involved in the hemp space? And so you advise Glass House. You guys have the series of glass houses, believe it or not, that are in Camarillo, California. And occasionally you are turning on a new greenhouse that might currently have peppers or cucumbers in it, and you're converting those to cannabis. And that's one of the reasons you've had this consistent revenue growth, is you're turning on these new greenhouses. Now you have this new fancy greenhouse coming on that has mixed light. So I think it has thousands, Seth, of HPS lights in it. So it's called a mixed light greenhouse that's going to produce theoretically higher quality cannabis than just the pure sun greenhouses. And you're making the decision: do I grow cannabis in there, or do I grow Farm Bill compliant THCA flower? Us, LEEF Brands, we have a 187-acre land use permit for cannabis. We also have a 100-acre hemp permit, and we're trying to figure out, we've planted cannabis on the cannabis side. We have the hemp side. We're trying to figure out what to do with that hemp permit. So I think we're pondering similar things as businesses, Seth, and I think you see that across the MSO space. When Morgan and I speak to, the bigger MSOs, all of them, part of the conversation is, how were you thinking about approaching hemp? And I feel like most companies are forced into being in a wait and see mode, meaning I don't know what's going to go on with the Farm Bill. And even more so these days, the state level dynamics are, dynamic, exactly like it sounds like. There's a lot of changes going on in terms of this is allowed, this isn't allowed. So when you're talking to companies that are looking for growth, because what I call the 2025 problem is that you don't have any new states turning on. We're waiting for Pennsylvania. We're waiting for Minnesota. And meanwhile, margins in almost every other existing state are degrading. That's why earnings were not good last quarter. And spoiler alert, they're not going to get good for the next 2 quarters, 3 quarters, until a new state turns on or something else changes on a regulatory basis, maybe with the Farm Bill. So when you're thinking about that, Seth, and you're advising public companies, how do you think about how and when to jump into hemp?
It's a great question. So you kicked off the show today talking about Buffett, and I am a dyed-in-the-wool, Graham value investor trained. And Buffett, in addition to starting with the balance sheet, kind of has 2 basic tenets, which is to focus on core competencies and make it simple, right? So the one really interesting thing about the Glass House asset is that it's pretty simple, right? It's grow as much cannabis at scale as cheaply as possible. And I think in Glass House, the decision to make a pivot in hemp is pretty simple, right? You're effectively growing almost the same plant in exactly the same environment without almost any restriction on it. So there, it was kind of an operational decision of, is this consistent with the core competencies? Is it simple? And does it make sense from a capital investment perspective? Okay. So there, the operation was, hey, this is kind of a hedge, and it aligns exactly with what we're like. No dollar that we're spending to turn on that greenhouse and plant hemp versus cannabis is going to be reinvested to do, or need to be redeployed or invested twice, right? So there's no replication. It's all accretive. When I look at what some of the other MSOs have done, and I've been relatively critical of them, they don't seem to adhere to those similar principles. And I hope I'm not going to offend anyone by putting Curaleaf in the crosshairs. But, when I look at the moves that someone like a Curaleaf has done, where, they begin to try to market a hemp beverage line that seems like it has little thought put into it, and then they come out with product that seems to be almost pandering. The level of genuineness that exists in the beverage industry is only, I guess, seen when you see the level of disingenuousness that the Curaleaf product set has. The other thing that they've done recently.
Let me stop you there. What does that mean specifically, Seth?
I think it's the difference between going out to your local tavern and having a $27 craft hamburger and having a McDonald's cheeseburger for 89 cents. That's what it comes down to. If you look at Curaleaf's latest, addition to the beverage line, it's basically a sports drink with THC in it that looks like Monster Energy. If you look at the universe of beverage products now, they kind of more look like something you get at a farmer's market or a farm to table or a bespoke or a craft. There's a customer connection there, and that base level customer connection and connectivity is something that I think large corporations sometimes don't understand. They just say, "Hey, we have a product. People are going to buy it because we're putting it through our supply chain. Doesn't matter whether it's red or blue." The other thing that Curaleaf has done, which I don't understand, is they've created a hemp retail store in Florida. So if I'm an investor in Curaleaf, and I want to get my number right, but I think they have 80 something retail locations in Florida that sell cannabis. I can't understand why I'm going to allocate capital into putting a brick and mortar storefront to essentially either cannibalize those stores or admit there is cannibalization to those stores and play off of that trend. It just feels like I'm confused by doing that. So, when I look at the MSO world, I feel like what people have done is made either bad acquisitions to buy into a space that they don't really understand, or have deployed capital in a fairly disingenuous way in order just to grab share or grab a piece of something. Because there's this matrix of why there's this Venn diagram of why things aren't working on the price compression side, right? Which is discounting, hemp, and black market. And when you look at the hemp and black market leakage from cannabis, I consider the two of you to be extremely much smarter than me. I haven't found data to be able to quantify those two forces reliably, right? So if I'm now making an investment decision based upon data that I can't understand, that doesn't feel like a good use of capital. And that's kind of what I see in a lot of the hemp strategy at the MSO level.
So question on, what do you think Glass House's market share is in California at this point?
At a retail level?
Yeah. I mean, I know you only have so many stores and one now MSA and potentially more, but you sell to, products are on, I think when we were there last year, it was like 200 stores or something that you guys find are credible to do business with. Is that right? Or
yeah, I am to be honest with you, I am probably not the best person to answer that question. I mean, I know that, in the quarter we reported $44 million. I know that our retail of our total revenue is about 10%. So I don't know what our market share number is in California based upon that.
Yeah. No, I was just kind of curious in your discussion of like the idea of, focus and all that, but with the idea of turning on a hemp greenhouse when, let's say, you have 10% market share, is that, just trying to tie that to your comment about why would these MSOs go into hemp, and is it cannibalizing or is it shifting focus and applying it to the same thought process of with Glass House?
I think we produce a lot of biomass and we're able to sell it. Right? We have a facility where we have 3 more greenhouses to turn on. I think whether we're planting hemp there because we're concerned about our ability to sell more biomass, or we're hedging against the future capability of us to not have interstate commerce, I think that's why that decision's being made. So if you're going to invest $10 to $15 million in another greenhouse now, or $15 to $20 million in another greenhouse now, and you can plant a product that you're not sure that you're going to be able to sell in the same quantity you're going to sell now, or you can make that capex and you could probably sell that product in all 50 states at a decent margin. I think what we're looking at is the end result of the same capex project, as opposed to making another investment in something which isn't a core competency. We have to deploy capital to upgrade those three houses anyway. So if we're going to do it and we can sell a ubiquitously distributed product as opposed to a constrained distributed product, I think that's where I make the distinction.
Okay.
Higher.
Well,
It's. I'm sorry. Go ahead.
I was just going to say higher margins too, right? Like if we're talking about pricing, my read, Seth, is that finished glasshouse flower in a jar, or I guess it wouldn't be in a jar, it'd be in a bag, but would be something like $900 a pound on the THCA market, and about half that, if not less, in the California cannabis market. Do those metrics seem about right for you?
Yeah, potentially. Potentially.
Yeah.
And the taxable equivalent yield is even worse.
Yeah.
But with hemp though, again, like, so if you grow, I mean, you can't sell it in California, right? I mean, all of that has to go to states where it can be sold, because we have an unfortunately very strict ban on activity, right? And I know other states have some bans as well, but yeah.
That is correct.
Yeah, it's wild out there. I mean, I'm not a fan of banning. I think it's nonsense. I think it's stupid. I think it's just regulators overreacting, in some cases rightfully so, because there's a lack of control and things are happening that are not good. I mean, we've talked about it plenty on this show, but are you guys trying to help clean up some of that, the bad behaviors that are happening in these other states, to try to set like a standard of testing and transparency, to try to help elevate or try to wash out some of those that are just selling cannabis and calling it hemp, or selling it to kids, like all these issues?
I don't know that I want to speak for Glasshouse's intention to be a crusader as it relates to the nationwide regulatory view on hemp. I don't know that is the corporation's job to do that. It feels like there is a so I don't know that that's our intention. It feels to me that there is a state-by-state patchwork of laws that changes and varies every day. And I think what we plan to do is to grow the product and be compliant everywhere we sell it, which is what we do in our core business with cannabis. I talk a lot about hemp, and what I'll say is inversion in the context of gun control. So we're not regulating bullets in the United States, but we do seem to have a gun violence problem, right? And as far as I'm concerned, it's not necessarily the regulation of guns that you need, it's the regulation of bullets. And what a bulk, cannabis producer sells is bullets, right? We're not selling the guns. So I think for us, it's just continue to operate under the same fundamentals that we do. You guys have both been to that greenhouse facility. It's built to export product across the United States. That's what it's built for. So if we can make a capital expenditure into it and create a product that we can potentially do that in, it's kind of a win for our shareholders, and that's the way that we're looking at it.
Yeah, to your point, Morgan, I know that Glasshouse, because I was chatting with Graham about it the other day, in terms of kind of working together on some messaging around, California hemp regulations. So yeah, I don't want to speak for either company on a national level, but I know you guys are, along with us, trying to contribute to come up with sensible hemp regulations in California, because it certainly is kind of a mess right now.
That I would certainly agree with.
Yeah.
That I would absolutely certainly agree with. Yeah. Yeah, and on the legal side, the cannabis legal side, we're just talking about some of the broken aspects, like California right now might automatically increase the excise tax. Hopefully that's getting resolved. Kind of surprised, or I guess I shouldn't be surprised, that Newsom doesn't seem like that's more of a concern. I did see a positive that they were trying to create incentives from the state to get more municipalities to open that have been historically, not opted in. So I do like the idea of proper incentives to encourage more growth in this state. But, it seems like there still are a lot of regulatory dynamics nationwide that are impacting the growth, whether or not it's even new states turning on. But, what do you kind of see from, what's outside of price compression? What is some of the limiting factors for more growth for our industry in legal cannabis? Yeah.
Capital is a major constraint, because there's no public equity. There's very little private equity that left outside of a couple of pockets, very little high net worth that leaves you with private credit. So, a lot of the fuel that fueled the industry from inception isn't there.
Mm-hmm.
I think the other thing is that if the three of us, as allegedly sophisticated capital markets people, we're going to look at assets, there's enough distress in market that if we went to market with, you said at the beginning of the show, $30 or $50 million, we could probably amalgamate a lot more and generate a lot more revenue and cost savings than you could by deploying that de novo into new things. So, those two factors alone, I think, are constraints for fuel. I think the other thing, which Jesse alluded to, is that I believe that most of the growth that you've seen over the last 3 to 4 years is not same store year over year growth. It's incremental growth as people are turning on new markets. And as we've talked about, there are not a lot of new markets to go after. So I think, as Jesse alluded to, I think 2025 is going to be a top line disappointing year for a lot of people. And I think it's going to cause more shakeouts. And the lack of available capital is going to make the situation harder.
Yeah. What do you think about license caps in general in these state-to-state markets?
I think they work. I think what I have seen, they favor the larger operator and the better capitalized operator, without a doubt, but they work. So like you guys, I probably pay attention to 14 markets, right? The market that I think functions the best out of any of them is Missouri. And what do you have there? You have license caps, and you have, a traditionally Republican state that seems to want to preserve cannabis and regulate hemp, right? Illinois is another state, seems to be functioning if you're there. Significant license caps. Let's look at states where there aren't any license caps, like California and Colorado and Washington and Oregon, and they were the first ones to come online, and they kind of went like that. So I think the limited license model, unfortunately favors the person with more money, but also seems to allow for a more functioning ecosystem across all players. Oklahoma is the best example of where that went wrong, right? So I'm in favor of license caps. It's not egalitarian. It doesn't work for everybody. It doesn't help social equity, but it's a model which creates better functioning businesses.
Maybe I can jump in, Morgan, with one last question, then we'll get to Ask Grok. But Seth, in our listener base, I know there's a lot of people that are invested in the larger MSOs, a lot of those through the MSOS ETF, which is something like, don't quote me on this, but something like 80+% in the top 5 names, what we would call the tier 1 operators, your GTIs, your Crescos, your Veranos, your True Leaves, and who did I forget in there? I forgot one. But the top, there you go. Yeah, so the top 5 MSOs. And if you look at the estimates for those, Seth, we're generally expecting mid-single digits growth for that basket. I think that might be generous this year. We'll see how it plays out. Setting aside those exceptions of the middle market companies and companies like GLASF or LEEF that have new assets turning on, which will drive more revenue, for that basket, what is it going to take for those stocks to return to growth?
Federal catalyst.
But does removing, or does Schedule 3 removing 280E, you think, lead to more growth?
I don't know whether it's 3 or 280E. The minute that you can put one of those stocks on NASDAQ is the catalyst, right? Because let's just, I've been super critical of GTI, right? I just buy more GTI, right? When I look at a stock that trades at 1.5 times cash with $1 billion market cap, with $1 billion P&L, and almost no debt and almost no tax liability, like that feels to me like a cheap stock. However, as a capital markets person, every single cannabis stock is a microcap stock. I don't care what you want to say. And no matter what it does, because it doesn't have the full armamentarium of the US equity capital markets looking at it, Ben could continue to not put out estimates and beat everyone's estimates on him, and he's not going to be rewarded for it, right? So I think what you need the velocity of the US capital markets and program trading and the several $1 trillion of buy-side capital that isn't in the industry to prop that up. The only other thing outside of that is peer-to-peer consolidation, and I don't think you're going to see that either, because our equity base is an event-driven base. It's not a technical, fundamental bit-driven base, and I don't know how you change that until you get on a higher exchange.
Exactly. That's go ahead, Mark.
I guess for those companies, though, to your point, like you get a listed exchange, what does that really do for the? Is it better for the company or is it better for the shareholder?
Well, let's play that out. I think it's better for both, because for the company, I think it opens up your access to capital and gives you more bullets in the gun, and gives you the ability to use that platform as a real platform. Because then the deals that we were seeing in 16, 17, 18, where I'm going to buy you and I'm going to give you a little bit of cash and I'm going to give you paper and I'm going to give you a note, you can start doing those deals. So it fuels consolidation because you have a capital thing that drops. And for the shareholders, you have liquidity, right? And you have potential upside, and you have a stock that's going to behave like a normal stock on a normal exchange. Like, I made a lot of money in grad school trading on the notion of earnings surprise, right? So, if all you did was trade on earnings, and most stocks on the NASDAQ, they're going to behave and they're going to go up. That doesn't really work in cannabis. So I think it's good for everybody, right? There's more money sitting in the U.S. public and private equity capital markets than there is anywhere on the planet, and maybe 0.5% of it is invested in weed.
Yeah.
So
I was just thinking about it in context of like some of the Canadians that trade on the U.S. and have benefited from access to ATMs and things like that. What have they done? They've just issued massive amounts of stock to clean up their balance sheet. And so it's been highly dilutive to existing shareholders. And you have to wonder if, at least 4 or so of those companies named, why wouldn't they do the same to shore up their balance sheet? And, at the expense of, ultimately it could be better, but, really like because to your point, like once you plummet into the exchange ecosystem, you can do all that. There's plenty of capital to cycle through that. But what does it do for actual shareholder creation?
It's actually a really valid point, and to be quite honest, it's the first time I've ever thought of it that way. And you're entirely right? Like it could be a disincentivizing event. I've only kind of looked at it as a half full event, not a half empty event. But it could certainly create that. I mean, I have also been rather critical of TrueLeaf. TrueLeaf has a $500 million tax liability on its balance sheet, right? So yeah, I mean, I think if we were being corporate finance jockeys and you're listed on NASDAQ tomorrow and you wanted to do that, it probably is a reasonable option for a company that might not benefit shareholder. I do think though that you get 2 overall sector bumps. If something happens, I think the entire sector goes up 100%. And if you were able to take someone like a Curaleaf or a TrueLeaf or a GTI and put them on NASDAQ, I think that's going to be a premium uplisting and capital event as well, irregardless of whatever else might happen downstream to dilute.
Yeah.
Which is also honestly why I see that core top 3 to 4 cohort as just pure value stocks. And again, for me, I'm lucky. I really didn't get in until COVID, right? So I just keep buying cheap and waiting, right? So I mean, I think GTI is $5.5 today. Okay. I'm gonna buy. I'm gonna just buy more of that stock, right? Like all day long. In a normal environment, that's at least if that's a pharmaceutical company, that's a $30 to $40 stock all day long, right? Like all day long. So I don't know.
Yeah, a year ago I think it was like 14. It's crazy.
Yeah, I think in early 23 it got close to 20, but yeah.
I remember the good old days. We had some expired warrants from back in the old days at 30 for GTI. Those babies expired though.
Yeah, and I think that's the whole opportunity. The way that I look at it from an investment perspective right now is that, broadly speaking, is it super attractive right now? I would say no. But I would say on the flip side, is the baby getting thrown out with the bathwater in some cases? Absolutely. And maybe that's like a GTI with a strong balance sheet and reasonable but not fantastic growth profile, but definitely the balance sheet to survive. Or on the flip side, are there companies like GLASF or LEEF that are turning on new assets that are going to drive more growth that might also be overlooked, or thrown out? So I think the theme for this year is to be more selective, but that doesn't mean there's not opportunities. And you could look back very well and say, there's a bunch of fantastic opportunities right now. I just probably wouldn't be buying the basket. I'd be pretty selective in what I owned.
I think so too. I think survival is winning. And one question that I have for you, Morgan, is you and your sister have been very successful in staying in the game. And I think a lot of the cohort peer that you had, the Meritas and the Entourage Effects and the few other of that first cohort kind of flamed out, because a lot of the investments that they made either didn't work or just went sideways. So, whatever your formula is, which I'd love to know in staying in the game, Bengal, I probably put in that category as staying in as well, has worked. And I don't know if there's one through line on that for you, but, I'd be interested to know what your thought is there.
Yeah, I mean, as we're still deploying capital in this year, in this environment, I think we've just always tried to be disciplined in trying to find good opportunities, but nimble in how we approach opportunities. And so we've, migrated our investment approach quite a bit over the years for the shifting dynamics. I mean, to your point about there's no exits, we're not underwriting exits anymore with new capital. None of that is just because we don't know. And we do have fixed kind of life in our company or in our funds, and so we have to be mindful of that. So I think it's just been trying to build and learn and try to not repeat mistakes. We've moved away from the perpetual capital raising kind of situations and said that that kind of dynamic is gone and exits are gone for now. And so how do we still approach the market? And so, we always try to think about when we're doing anything as, let's really assess the landscape and try to be thoughtful about that deployment. I feel fortunate that we're still here after, fortunate, I guess, depending on who you talk to. But, we're still here and we're still working. We've got some really great companies and, but we've also been, to that same point, been very disciplined with companies, and those that took advice from us are still here where, when COVID hit, we told them you're never going to raise another dollar again. And those that took that seriously, got to a point where they were generating cash and have been able to self-fund themselves and building really nice companies. And this is not just operating companies, this is technology companies. And, I think we've changed the whole dynamic of you need 100 million in SaaS revenue to be profitable. I think that's bullshit. I think that's an old mentality of ZERP era. And, we're proving that, very clearly companies 5, 10, 25, 30 million and up in SaaS revenue are profitable enterprises. And they're, growing just fine, far surpassing the rule of 40 because they have top line and profit. So, very proud of the companies. They've also learned and worked incredibly hard. And, we just try to find, I think that's, the most important through line, and tying it back to Berkshire and Buffett and Munger, just stewards of learning, right? Always learning, the compounding effect isn't just on capital, on mentality, and just, always trying to learn and grow, and not just spinning wheels.
Well, it's a pleasure to be on the show, and it's really a pleasure to see the longevity that you've had in the space. And I think we all owe you and your sister a thank you, because you were one of the first out there, really, really holding the banner for a lot of us. And thank you for that. But it's also interesting there that the one thing, and I'll give my friend Craig Fox a shout out, actual freaking cash is what it's about. And the one consistent thing that we've talked about today is that the most successful companies and the one that are going to be successful are generating cash. We're figuring out how to generate cash. And that seems to be what separates the wheat from the chaff right now.
Craig, if you're listening, I'm still waiting for that cool California Sober t-shirt you're going to send me. So I had a good chat with Craig. We were talking about California Sober, and he threatened to send me a t-shirt. So if you're out there, Craig, I'm still waiting, buddy.
I think he's on vacation. He's on vacation till tomorrow, but I'm sure he's going to come hot into my text messages at about 7:30 Pacific. That's how that usually goes. But Fox has been a great friend and mentor. So
you want to wrap us up here with? Oh, sorry,
investor.
Seth. Yeah,
and a good investor. Good investor too.
Nice.
You want to take us home here? We're just a little bit over the hour. Morgan, finish up with an Ask Grok, and we'll get Seth out of here.
Yeah. So my question this week has been kind of in looking at all these cues and management commentaries and how they're managing the pricing cycle. So my question to Grok, this is an educational piece this week. I asked, what is reverse operating leverage, and how do companies successfully manage it? And Grok's answer: reverse operating leverage occurs when a company's fixed costs amplify losses as revenues decline, causing profits to drop faster than sales. It's the downside of high fixed costs in a business with declining sales, as those costs don't scale down as easily. How to manage it successfully: cost flexibility, shift from fixed to variable costs, e.g. outsourcing, flexible labor contracts; revenue diversification, expand product lines or markets to stabilize income; efficiency improvements, streamlining operations to reduce fixed cost burdens; financial prudence, maintain cash reserves or low debt to weather the downturns; and scenario planning, use forecasting to prepare for revenue declines and adjust costs proactively. By balancing cost structures and maintaining agility, companies mitigate the impact of reverse operating leverage. How does that sound to you guys?
Sounds reasonable. I think that's a pretty good definition.
Did you have any big takeaways before we let you run, Seth? I'm just curious. Did you have any big takeaways from the gold floor situation?
I'm going to give you an exclusive.
Okay, I'm ready.
You're hearing it first.
Which is that I did not publicly comment on the gold flora situation because I really like Lori, and I was really rooting for a good outcome. As I have espoused many times today, I am usually the dumbest person in any room that I am in. I failed out of 11th grade mathematics. So that story for me has been 5 years in coming, and it reached its inevitable conclusion. I think every single person in the industry looked at trying to figure out a way to take the parent company over, and got in there and realized that there were either a series of contracts or a series of assets that didn't fit. I think Lori got left holding a very difficult hand of cards. With no disrespect to my friends at AGP, they put in a hot, smelly, dirty, toxic financing from a firm that none of us had ever heard of. And when I looked at the income statement of that company and the balance sheet of that company, I think her best outcome was to potentially get an ERTC refund at some point during the end or early this year to pay off the old piece of paper and potentially fund operations. But she was still running at a several $1 million a quarter net operating loss. So I think anyone who was an educated or interested party in that story realized it was a matter of how long was she going to keep the lights on. Now, I do think her story is a little bit different in that, she still does control two of the better retail operations historically in California and Airfield, and she really only has about $16 million of liabilities that's come due initially. So I do think that from a receivership perspective, she could probably generate cash for those assets and do what Polaris and State House had done and kind of rationalize there and live to play another day. But the inevitability of that going into receivership is something that I have privately talked about probably since last summer. And just because I didn't want to publicly denigrate someone who I think is a great operator, I did not publish, talk about it, or write about it. But that's my view.
Yeah, that's a fair perspective. But it's right now, Seth, it's a going concern receivership. And I'm not an attorney and not an expert, but my understanding is that you have to buy the whole pie. You can't start parting out those really good pieces like some of that retail.
Good luck.
Yeah.
Good luck. All three of us sit in California. State House was, I think, out as a going concern receivership publicly. Privately, if you were in the know, that was two classes of creditors fighting one another for one class of creditors to get more. So, last time I checked, the High Times assets is still in receivership. So good luck, Richard Ormond, and good luck to the receiver there. That is not my circus and not my monkeys.
Yeah. Okay. Well, awesome, Seth. Great to finally have you on the show. Really appreciate joining us today. I think it was a good conversation.
Gentlemen, big fan, super appreciative of the opportunity. Thank you so very much. And I'm sure I will see you both in person, probably in Chicago soon, and somewhere else in the very near future.
We will be there.
I have a feeling it might be an arm wrestling contest between you and Boris after today's comment.
Yeah, we could market that for Benzinga.
Yeah, fundraiser.
Ah, great. Listen, Boris, my number is 323-356-6321. Call me, bro. I'll save you $40 million this year. Call me.
I think that's the place to leave it, Morgan. Thanks, Seth. Thanks, Morgan. Thank you all for listening and watching on YouTube, and we'll see you again soon.
Thank you guys so much. Appreciate it.
The views expressed in this podcast are provided for informational purposes only. Nothing we say should be considered research nor a recommendation. All investing involves risk, including the loss of principal.